financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, August 22nd. Here are the top market stories that we're following for you. Is disarray at Dick's. The stock sinks as theft hurts profits and drags down peers like Academy Sports and Nike. And the tech rush. The Nasdaq 100 up almost 2% over 2 days. We're going to see if you should chase the rally or buy value. And the housing hump. You got low shares of 3%. Results aren't good enough. We're going to get instant analysis with Lawrence Yun, chief economist over at National Association of Realtors, as existing home sales drop right now. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. All right, Guy, what do you got?
This market's broken. Nothing is happening. Everybody's looking at the kind of very low rates they've got currently. Alex Steele, I'm looking directly at you and thinking, why do I want to trade to a new home? The data reflect that and continue to reflect that. They come in soft. Existing home sales, the headline number, 4.07 million. That's down from 4.16. That's a month-on-month number that is negative 2.2, down from negative 3.3, but the market was expecting maybe some stability to come through here. Alex, we've got two markets. You've got two housing markets in the United States. There's no two ways other than putting it that way. The situation is that the existing market is being supported by the fact that nobody's moving. I suspect prices aren't therefore moving very much either. The new home market is being supported by the fact that actually people do need to move. There is only one option, and actually, I don't think many people are actually paying the headline rate that we're seeing at the moment either, because I think there probably is discounts being applied. So that market is functioning, but for how long?
There was a story out, I think it was on the Bloomberg yesterday, that did say that the super wealthy were even having issues sort of getting that price down. Like the good, the benefits that you got from having a super solid balance sheet weren't as good as they were even a few years ago. But I have to say, I was at a barbecue this weekend, and guess what came up? The housing market and sort of the free money that was given out to people who have like sub 4% rates. As long as inflation winds up staying high, that's like all free money. And that could have like structural huge shifts for the housing market for years to come.
But I don't know how long it lasts. At some point, many people do have to move. If you've got a new job, you've got a family that's growing, there are many factors that may force you to move. And it's going to be a real wrench at that point. And the longer rates stay higher, the longer that process unfolds for. If rates go up and come down very quickly, then yeah, people may be able to work their way through this process and keep their existing rates. But the longer it lasts, that doesn't work. And I think that's going to be the narrative that develops from here. Or
do you just revamp your old home a la Lowe's, or do you wind up just paying up for a new home? So maybe the bifurcation shifts a little bit. In the market, though, you know, what was really puzzling over the last 24 hours was the move higher in tech, because it seemingly came out of nowhere, and that drove tech stocks higher in China as well as in Europe. And you take a look at the Nasdaq 100, this is a 2-day chart, and you can see we're up like 1/10, like not that much right now, but that move around noon yesterday, I could not see a headline, but there is a lot of talk about how NVIDIA is leading big tech, which leads yields. So it's actually the volatility coming through tech to the bond market to pay attention to.
Yeah, there's a lot of options activity that's happening in advance of NVIDIA, isn't there? I was also confused by the China story as well in terms of the spike we saw at the back end of the session there. But maybe there's an arm factor in all of this. The real question, Alex, and this is our question of the day, is do you now chase tech? It's been a really great run. You've got rising yields. Is that a headwind? Valuations obviously are getting pretty punchy. Do you continue to chase this move? Callie Cox, eToro US investment analyst, joining us now to give us a take. Callie, what do you think? Do you chase the rally that we saw at the back end of yesterday's session?
Well, I think the question is around the word chase. I mean, what time frame are you really looking at here, Guy? Because I'd say like over the next days and weeks and probably over the next month, yields could stay high for quite a bit. But the pressure in itself is on the economy right now. And, you know, if you think yields are going lower over the next 6 to 12 months, then tech could be a good buy here. But you also have to remember that there are different flavors of tech, and, you know, interest rates, even if they do move lower from here, are still, you know, biased to be higher. So, you know, maybe you look for quality.
Right. Okay. So that's what Bill Dudley was talking about, structurally higher yields, not just even the short term, but overall. Our start is higher. The term premium is going to have to be higher. So at what point do you know the right balance? Like, value tech, like what is that? I'm assuming you're not going to be buying NVIDIA, for example.
Well, I'm not going to speak to NVIDIA. I think it's really hard to value, such an eccentric stock at the moment, one right in the middle of AI. But I think you have to really just step back and understand, how long you'd be able to hold on to these tech stocks. And again, looking over the next 6 to 12 months, tech has good earnings growth ahead of it. A lot of that earnings growth is driven by the bigger tech stocks, and these bigger tech stocks are conglomerates as well. They're not just based on one, business line. So I think you could consider those quality, and I think that there is an argument to see PEs run a little bit higher there.
So Callie, can I hold in my head the simultaneous thought that I believe in big tech, the conglomerate mega caps, and I believe in higher for longer? Can I hold those two thoughts in my head, in my portfolio at the same time?
I think you can, but you have to remember, portfolio positioning isn't just black and white. And I think you do need to position for the fact that rates could stay a lot higher, and that could eventually weigh on tech. I'm thinking of tech's potential from an earnings perspective here. Big tech has huge competitive advantages. They have a huge cash hoard. They could likely survive a recession, compared to a lot of other stocks. So I think big tech is attractive here. But, if rates stay higher, it may make sense to, maybe look at some cheap cyclicals here and there. And I wouldn't necessarily call big tech cheap at the moment. But in terms of, earnings growth potential, it does look attractive.
Guy, can we just talk about the fact you said, can you hold these two things in your head? No, you can't. Maybe some can. I don't know. That was a pretty wonderful description. Tech and yields kind of in your head. I have a nice image.
I think it's a challenge. They seem to be competing, but in theory they're not.
Okay.
Holding two competing thoughts in your head is something I struggle with on the best of days. I think I'm like the market. You can only do one thing at one time, and that's the way that you should progress.
I can 100%.
Focus on one thing, move forward. But the problem with the market at the moment is the narrative changes all the time. So you go from having one thought to another thought, and then you're back to the first thought, and then you're going to another thought. That seems to be the story of this year.
And this is why our editorial meetings take 45 minutes. I'm kidding.
This is true.
Sort of. But Callie, to that point, one narrative happens, then you have a reaction, then another narrative, etc. And I'm wondering, are we making too much of the price action in the medium term, in that there are a lot of put options being put on, no pun intended. There has been a lot of talk about short gamma, so you got to cover the hedges, and that's really driving the intraday stock moves, not really to take that very seriously. What do you think?
Well, you also have to remember that, even in bull markets, prices can go down, and, sell-offs happen even in healthy markets. I look at the options exposure over here. Options have never been more popular than they are right now, and it doesn't surprise me that options flows are possibly bleeding into the stock market. Also doesn't shock me that people are buying puts. Stocks are within 5% of record highs, or at least the S&P is. So I wouldn't put too much weight on that. I think that, a lot of that activity is normal, but, if you are a short-term trader, I think you have to do what Guy alluded to. You have to put, multiple views in your head and think about ways to express them.
Is this a stock picker's market, Callie? To that narrative point, but it must be really tough, because the narrative changes really quickly, and therefore the stocks change quite fast. Other than the mega cap tech stocks, does it work for the rest of the market? Because the index is going higher because it's being dragged higher by those tech stocks, but the rest of the market, not so much.
Well, I think it is a stock picker's market in the classic sense of a lot of stocks are moving in different directions. I looked at the number of stocks that are actually down since the October lows in the Russell 3000, and a good 30 to 40% of Russell 3000 stocks are down. And there are some trends there, like a lot of smaller stocks are down. We're seeing financials take a hit to the chin right now, and really they have since March. But I think if you're picking stocks here, you really have to understand what you're going for and how long you might have to hold, because it's a treacherous operating environment. Rates are still high. Costs are still quite high as well. So, that's where quality comes in. And that's where I think you have to really look for the durable stocks that can survive a recession.
Hey, Callie, you were talking about value cyclicals. Does that mean Europe?
I'm U.S. focused. I think, if you want to extend it globally, you see a lot of value in the U.S. I think that you could make an argument for value in Europe, especially because industrial stocks are showing a lot of value, energy stocks showing a lot of value as well. But Europe is a different ballgame here. They're more exposed to China. They have a different kind of inflation happening over there. I think that there's an argument to invest in global stocks, but you'd almost have to shift your case.
Alex, as far as I can tell, the Americans are very happy taking their vacations here, but not very happy owning our stocks. So you come over here, you enjoy our weather, you enjoy the food. Stock market, not so much.
Yeah, that discount for European equities, we talk about it a lot, but with 36% now, the average is 16. I mean, that is that's quite a bit. I was surprised at how stark it was.
Yeah. You're coming. It's not like you're picking up souvenirs. Oh, that's a great stock. I'll take that home with me. It doesn't feel like that at the moment.
No.
Europe is packed with Americans, but those Americans are not investors.
Yep, and then what happens when they actually leave and then don't go to Europe at all? Then it's painful on both sides. Hey, Callie, thanks a lot. We appreciate it. Callie Cox of eToro. Remember, I'm done with vacationing. I'm done with budget. I'm done with any budget. No, I'm on a budget.
No, your budget still exists.
My budget exists. That's what it is. Okay, and I'm not going on any more vacations. All right, coming up, existing home sales dropping in July. We're going to get instant analysis from the person behind the numbers, Lawrence Yun, Chief Economist at National Association of Realtors, is coming up next. This is Bloomberg.
This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
So let's go back to the top of the hour. We saw the data dropping for existing home sales. They're down to their lowest level in July. Lack of inventory, higher mortgage rates weighing on the markets. To be honest, this is a broken market. And what signal you get from it, I think, is very difficult to determine. Let's get some instant analysis, nevertheless. The Chief Economist of the National Association of Realtors, Lawrence Yun, joins us now. Lawrence, great to have you on the show. Great to get some instant analysis on this number. What is it telling us, other than the market for existing home sales is broken? People don't want to move because they got very low rates. They don't want to move because they don't want to lock in higher rates. When does that change?
The home sales struggling principally because of lack of inventory. Consider 1/3 of the property right now are being sold above list price, meaning that multiple offers are still happening. It's just that lack of inventory condition. So how do we get more inventory? Well, certainly the builders are adding inventory, but the way to really get more inventory is for the gap between the current mortgage rate that the homeowners have versus what the market is offering. So if somehow the mortgage rate was to go down to say even 6%, I believe we're going to have some degree of pent-up sellers beginning to reach the marketplace. Remember, changing family circumstances, additional child in the family, look for different school district, new job at different location. At some point, people want to move even at higher mortgage rate, but the mortgage rate needs to come down.
Lawrence, hi, it's Alex in New York. It's great to have you on the Instant Analysis. What areas within the data, what areas are still the tightest in the existing home market versus ones that are a little bit looser? Anecdotally, I'm in New York, and it does feel like I keep seeing price reductions on existing home sales right now.
Well, in the upper end market, there is some price concession at the upper end. So the multiple offers are happening principally on the mid-price home, moderately priced home. There is a job creation happening, 4 million people working today versus pre-COVID. They want to be an owner. So there is a demand at the low end. Interesting part is that the West region actually suffered more before today's data. After some price decline that was experienced in the West, people are viewing it as second chance opportunity to get in. So the West region actually outperformed other regions in the latest data.
How does this all correct itself, Lawrence? This is the bit that I'm wondering. America continues to underbuild. The new market is doing very well, but it's still not supplying enough homes for Americans. The existing market, nobody's moving because they don't want to lock in higher rates. How long does it take to correct this situation? How long are we going to have to wait before these markets normalize?
Well, you have been underproduction for many years, and the cumulative effect of underproduction is we are short on homes. And consequently, if one looks at the long-term perspective, from year 2000 to today, home prices have risen roughly 180%, while people's income have only increased by 100%. So we have a mismatch principally due to lack of construction. So we either need to provide incentive to produce more or possibly consider temporary tax incentive for some of the mom and pop real estate investors to unleash some of their rental property inventory. Even if we can get, say, 10% of those inventory onto the market, it will greatly loosen the condition.
Yeah, that's such a good point. You did mention, though, that the middle end of the market is where we're seeing competing bids come in, and that's where we have seen the job strength and we have seen the pricing power. But if the job market starts to soften and loosen up a bit and the price concessions aren't as high, which we're getting reports that that's the case, what happens to the middle end of the market?
So, what we have right now is that home prices turned positive in the latest data. So we had 5 straight months of negative prices, but this month turning positive. So housing recession, at least from homeowners' perspective, their wealth is over already. So what we need is more inventory. If the interest rate decline, if the Fed can say we're done with raising interest rate, lower interest rate means not only more buyers coming to the market, but the pent-up sellers wanting to move out of their existing homes.
Okay, Lawrence, let's talk about government policy that could make that happen. You alluded to some just a moment ago, maybe forcing some buy-to-let sort of landlords to push their homes onto the market, put their properties on the market. What else could be done? What policy would help in this situation? What should the government be doing?
Back in after the Second World War, when many of the soldiers returned to the country, they want to own a property. So there was a big push to build more homes. So Americans became homeowners. So maybe we need to consider, should part of the infrastructure spending bill, we need to build bridges, we need to build highways, but maybe we should also focus on helping build more homes. So that was one. Tax credit incentive to perhaps transform some of the disused property, whether commercial office building into residential units, and immediately provide some tax incentive for mom and pop investors to say, look, you sell it to the first-time buyer or first-generation buyer, and you get a tax relief, so we can have more inventory coming onto the market.
Sounds interesting.
Yeah.
Lawrence, let's hope somebody's listening. Lawrence Yun, Chief Economist at the National Association of Realtors. Thank you very much indeed, sir. Okay, we're going to turn from property back to tech next. SoftBank's ARM has finally filed for its long-awaited IPO. We're going to look at what it means for tech IPOs. In its wake, what happens next? The startup is about to happen. We'll take you to San Francisco to find out. This is Bloomberg.
It is 22 past 7 on the West Coast. We want to get to the startup, where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. All right, Ed, we got the ARM prospectus. What were some of your biggest takeaways? It feels like we've been waiting, Silicon Valley's been waiting for this moment.
Yeah, I mean, the ambition of Masayoshi Son and SoftBank has been that this IPO would be mega. You know, the filing left out a lot of details, but if they raise $10 billion, it would be the biggest IPO since Rivian's in November 2021, which the three of us covered so closely. I'll never forget being on Bloomberg Markets with you guys when that opened, trading started opening. It's definitely a starter gun moment as well, right? I think what I hear from folks here in Silicon Valley, from founders, from their bankers, is that we're looking at how this one goes, because it will either start as a catalyst for other IPOs, or it will get everyone to hit the brakes a little bit as well.
Okay, so the next question that follows on from that is, what does ARM mean for my feet? Almost specifically, my Birkenstocks. What else is going to be in the wake?
I get it.
What else is going to be in the wake of the ARM IPO?
Well, look, there are a number of companies waiting in the wings, right? Turo is one, the car-sharing app, or peer-to-peer car-sharing app. Instacart, another. It gauges investors' appetite for the technology play. You know, ARM's a really interesting one, because one reason that you do an IPO isn't just to raise money. It's for the publicity, the sort of prestige. And to be frank with you, there are loads of people around the world who have not got a clue what ARM is or what it does. They just call it a chip company, but it's much more specific than that, right? ARM designs the blueprints for chip design. It also has the IP on the code, which impacts how chips interact for the software that they're carrying. Their history is in smartphones and in energy efficiency. But the bet for the market is, well, hold on, is this an AI play? Because that's the story that ARM and SoftBank have wanted to tell.
Well, yes, of course, they want to tell that. First of all, guy in Birkenstocks, I don't know, I would totally pay for that because you know you wear stocks.
I bought a pair of Birkenstocks,
don't you?
I bought the pair of Birkenstocks in New York City 20 years ago on a very hot day with a cameraman friend of mine, and then walked across one of the bridges, and it was one of the most uncomfortable walks I've ever had. They're now very comfortable, but it's taken a while.
Do you wear them with socks?
Of course, I'm a European.
Oh my God, this is insane. Okay, Ed, what we also learned, aside from that guy wears Birkenstocks and socks together, is the ARM's exposure to China, and I don't think that the market also fully appreciated the sort of risk there, and we got that in the prospectus. What did you learn?
Alex, I've got to be honest, my IFB dropped. Say that again. I've got you back.
Oh, you got me back. ARM's relationship to China and the exposure there, that's a risk that's very well outlined in the prospectus.
Yeah, it's very well outlined in the prospectus because go back to its history that it's a cornerstone of chip design. There are many domestic manufacturers of semiconductors in China, but also the domestic handset makers. You know, ARM is pivotal to the design of smartphone, not just the modem or chipset, but also the energy efficiency side. It's going to be interesting because right now, ARM's ambition for its involvement to design next-gen data center chips and AI, it's not a problem, it's an ambition. Its existing influence and engagement with China isn't caught by US restrictions. But obviously there's a warning there that that could change.
Yeah. Ed, is ARM perceived as a UK company?
I knew you would ask this. Yeah, it's really interesting. Is it a gut punch for you guys that they listed in New York and not on the London Stock Exchange? Right, but they would still say that they're UK based, that a lot of their engineering talent and design talent are based out of one of the world's top universities in the UK. But an IPO is next level prestige if you're doing it on the New York Stock Exchange, and we've had that discussion on the show a lot in the last few weeks. A gut punch.
Yep. It doesn't feel good over here, I have to say. But the Birkenstocks do. I could see Ed Ludlow in a pair of Birkenstocks. I think
with socks, though. He definitely wears socks.
Quite a few pairs, actually,
But there you go. There you go. Ed Ludlow, thank you very much indeed. Looking forward to the show a little bit later on. Bloomberg Technology coming up. This is Bloomberg.
an hour into a trading session. We are seeing stocks lose a little bit of steam, but after what we saw yesterday with the tech stocks, it's hard to make a lot of it until we really get to that close, which is that big bounce up. Abigail's tracking the move. Abby?
Yeah, agreed, Alex. It's hard to know what to make of this period, given the fact that we had the S&P 500 E-mini futures higher into the open and now kind of rolling over. It's not really clear what the cause is, especially given the fact that at this point yields are mixed. The Bloomberg Dollar Index really not all that much of a pressure. It does look like, actually, it's to Alex's point, it's hard to know what's going to happen here. If we take a look at what's happening beneath the surface, though, lots of movement. Tesla finally getting a bid, up 1.6%. Lowe's up 3.2%, a better quarter than expected. Comp sales beating Home Depot, down just 1.6%. They also held the outlook. To the downside, though, Schwab down 2.9% on a variety of news, including job cuts. And then J.P. Morgan down about 1%, down in sympathy with the banks. Now, when we connect this to, and that on the S&P downgrade, of course, following Moody's. When we connect this with the S&P 500 technicals, this little bounce that we're having, this is the S&P 500 relative to its 50-day moving average. We showed this yesterday. It's important because it does make the case that we could see the bounce last a little bit more, but it doesn't really mean all that much because this near-term downtrend is still in play. If it were to break above that downtrend, then it would be something interesting to talk about. And frankly, Carly Garner of DeCarlyTrading.com, who often joins us for Options Insight, she thinks we are going to see a bounce, really move into something a little bit more, and she's been excellent over time. So let's see how it all plays out. And then finally, we of course have the disappointing existing home sales number, but this is not affecting home stocks, home building stocks at all, Guy. On the day they're higher, on the year they're rallying in a huge way, and it makes sense to a large degree from the standpoint that if there aren't a lot of existing homes out there from an inventory standpoint because of rates and people are locked in at lower rates, well, go out and buy a new home. So these home building stocks, they're really on fire this year.
It's been an incredible run. I had some weakness recently, but yeah, I take your points. And I think Toll Brothers reports after the bell. So we'll look forward to seeing exactly what it has to say a little bit later on. Abigail, thank you very much indeed. Perfect setup. Let's move on and carry on our conversation about what is happening with the real estate market. Danielle Hale, Realtor.com chief economist, joining us now. Danielle, we saw the numbers at the top of the hour. They were weak, but what do they tell us? What do they really give us? Do they really give us much insight into what is happening here? We know the existing market is largely broken, and we know since that data was taken, rates have gone even higher.
Yes, we know that July home sales, as you mentioned, were down a bit. They're still above the floor that we set in January of this year, so the market is continuing to operate at a low level. I think it just highlights the challenge that buyers have in today's market. Buying an existing home, finding an existing home, and then trying to find one in budget is incredibly hard. That's why we're seeing new home sales do a bit better, because builders don't have the supply challenges that we're seeing in the existing market. A lot of existing homeowners are choosing to stay put, enjoy their home. They're very low mortgage rate, especially compared with mortgage rates that are now, creeping up past 7%. And so we're not seeing inventory. That means buyers can't buy what's not for sale.
Well, to that point, Danielle, when do we see the effect of 7.5% mortgage rate? Because we can say that new home sales are still going to do well, the home builders are going to do well, but when are we going to see the effects of that really high 30-year?
Yeah, I think those are going to be more evident in the next couple of months. We saw last year when mortgage rates topped 7%, that was when home sales really kind of plummeted back down to that 4 million sales level, and we've had trouble lifting off of that level. So I think the next couple of months ahead are going to be a challenge for the market. To the extent that builders can offer flexibility in the rates that they have, they have generally been good about offering buy downs and that sort of thing to make housing more affordable for buyers today. So that has worked well for builders, and so I expect we're going to continue to see new home sales outperform.
Okay, let's just to dig into that a little bit more. So what do you think the average rate that people are paying now, considering those buy downs? Is it 100 basis points lower? Is it 200 basis points lower? What do you think the average number is? And are we going to get to a point, to Alex's point, where actually those buy downs are not going to be enough? And what other incentives do you think the builders could offer at that point?
I mean, I think the buy downs are important for builders, but it's important to remember that the new home sales portion of the market is still only around 15 to 20% of the market. So the vast majority of home purchasers are still probably paying that headline rate close to 7%. That's one of the big reasons why we're not seeing as many home sales today. When you consider just a year ago, rates were substantially lower before they really shot up. Now, the good news is, and it's hard to think about this now, but we're getting close to the end of the Fed's tightening cycle, likely. I think this is the last gasp for mortgage rates and interest rates. I don't think they're going to come down quickly, but I do think we're very close to the top. And so I do think that is going to help the housing market once rates start to ease back down, which we'll likely see as we move into 2024.
Danielle, how has the household savings helped the market? And I'm wondering when that starts to roll over.
Yeah, I think that has been a really important part of the story. So, we've seen interest rates of all kinds move up in the last year as the Fed has tightened monetary policy. Nevertheless, consumers are still spending, and that has been one of the really big surprises that we've seen. The labor market is still doing well. Consumers have money. A big explanation for why we're seeing that is that households had a lot of savings that they built up during the pandemic, and that has they've tapped into those savings to make up for the fact that their incomes aren't keeping up with the cost of living increases that they're facing. And that is likely to run out as we move into 2024. So I think that's been a nice boost for the economy going forward, or in the past, but going forward, we're going to have to see something change. Incomes are going to have to keep up better with the cost of living, or we're going to have to see consumers pull back on their spending. So that's a wild card that I'm watching as we move into the next year.
Danielle, if the Fed Chair, Jay Powell, on Friday talks about the fact that rates are going to be higher for longer, what does that mean in terms of those people that at the moment aren't moving because they've got a very low rate locked in? Alex Steele is one of these people.
True story.
And at some point they may have to move.
Not happening.
If higher for longer is the new reality and rates stay, maybe not where they are now, but they stay kind of elevated and we don't go back to the pre-pandemic era, at what point do many of these people, when are they going to be forced to move? Is it when the labor market cracks and they're going to have to start moving to look for jobs elsewhere? Do you see a catalyst for making that happen?
I don't, and I think that puts me in the minority. I think it's going to be one of those things that happens slowly and gradually over time. We're not going to hit a cliff where all of a sudden people are at a rate where it just makes sense for them to jump back into the housing market. I think over time, life changes, your employment situation changes, your family situation changes, your current house gets more and more uncomfortable because it doesn't fit your current needs, and it becomes worth it to make a move even if you're looking at a bit of a higher price. The other thing that happens, especially if home prices remain elevated, is that you build up equity by paying down that mortgage over time, and so that equity cushion is something that existing homeowners can eventually use to help offset some of the shock of mortgage rates that remain higher for longer. So I think we're going to see sales pick up gradually over time, but I don't think we're going to see a sudden surge because I don't think we're going to see mortgage rates come back down to a level where we would get that surge.
Danielle, thanks a lot. We really love talking to you. Danielle Hale, Realtor.com, chief economist. Of course, this is the moment where I get to talk about my 2.75% mortgage rate. But to that point, if something were to happen or if there is financial difficulty, you're right, the equity is in the house, but then that winds up changing how you view it, right? It's an asset now. It's not somewhere where I get to live on free money, basically. And then it becomes a different kind of calculus. And if we get there in the economy, that's a different kind of story.
Yeah, all of that's true. I'm thinking of Lowe's today, and I'm thinking of Home Depot, and I'm thinking of what was happening with their numbers and the structural story that I think is over a longer term period are going to be working for maybe those businesses. If people aren't going to move, to what extent can they make what they've got work for them? Now, that probably doesn't work in a condo, does it? But it might work in a single-family residence. You can expand. You can go into the roof space. You can build over the garage. You can do all of these things. And I'm just wondering how much of that is happening in America right now.
Yeah, that's a good point. It feels like probably less than it did before, and you can see that in the numbers from Lowe's and Home Depot, and they're saying that customers are still very reticent for those big ticket purchase items and that they're a little worried about the back half of the year. However, if the mortgage rates stay high, then you can make an argument that that's going to be the next stop. But if you did a full revamp during COVID, you're not going to spend like $100,000 revamping something.
No. But people's lives evolve, and you have one child and the house fits. You have another child, maybe you need an extra room, so maybe you go into the loft space. You need more space. You need an office. Maybe you go over the garage. So things change, and I'm wondering to what extent the housing stock allows that to happen.
Yeah.
And it's certainly been the case over here. It is so expensive to move because of taxes, you're shifting your mortgage around, all of those kinds of things, that actually often it is still and this point in time looks very much kind of exactly at that sort of stage, that it is easier to build than buy. And I think that you got a little bit of that over Home Depot, out of Home Depot this time, and I still think you get a little bit of that out of Lowe's in terms of developing.
Yeah.
So it's going to be fascinating to see how America deals with this.
No, it's definitely possible, and obviously it depends if you're talking about New York City, which has much more limited
Well, that's what I
areas,
mean.
or
About
any
you
other
can't
place
do that
in the world.
Yeah, you can't do that if you're living in a condo.
Yeah. Anyway, we're going to continue that conversation because if we learn anything over the last 12 hours, it's a rough time for certain spots in retail. You got shares of Dick's, Macy's are lower. You got some lackluster results. Too many markdowns for Macy's, and Dick's just was pretty terrible. We're going to break that all down next. This is Bloomberg. One huge mover in the market, Dick's Sporting Goods. Shares are tanking here, cutting its profit outlook. The call is underway. The company is saying that theft hit its second quarter profits pretty hard. It also wound up shrinking margins as well. Meanwhile, just touch on Macy's here. That stock also down. There were markdowns that had to clear the inventory, and that really cut in to their margins and sales as well. Bloomberg's Simone Foxman is watching the space for us. Can we just start with Dick's? I guess the question is, like, why was it so bad, and how are they so surprised?
Yeah, I think it's just that this is the company talking about shrink and retail theft this quarter. I mean, we had Target talking about the $500 million hit that was going to take on its earnings last quarter. That really drove some anxiety. And now here, Dick's is suddenly out again with this idea, talking about, I think, one of the latest headlines to cross that a third of the margin decline is going to be due to shrink. And back to school, apparently, and this is the call is ongoing, as you said, is one of the key times at which this shrink really makes a difference. So I think there's a concern that this is not all baked in. And, you know, this scale of these adjusted earnings changes, looking for EPS 11.50 to 12.30 over the year. Initially saw 12.90 to 13.80. The estimates were towards the high side, I think, just pulling down investor expectations so substantially, and that's what's moving the market today.
Yeah. Why is Macy's on sale as well? Like, I looked at the numbers when they first hit the tape this morning. They looked okay.
Yeah, and honestly, shares were not down like this pre-market. We've seen this cynicism really escalate over the course of the day because, frankly, the comp store sales actually beat what analysts were expecting. They were only down 7.3%. So that is a substantial number. These were never going to be pretty. But I think the concern is that these sales, better than expected as they were really driven by a lot of this promotional activity. So that's going to cut into margins. It means the consumer is not as strong as people thought. I mean, you look at Bluemercury in particular. This is the beauty segment. This is the skin segment. You know, comp store sales really strong there, up 5.8%. But then when you hear the call, markdown driven.
Interesting. Invest in your face is a big takeaway. So I'm really curious, Guy, as to what kind of sales and promotion we're going to have to see going forward. Because I'm a salesperson. I'm on a budget. If you offer me the right sale, Bloomingdale's, I will go there. And I'm wondering how much more they're going to have to do promotional activity in order to clear inventory, or if they're done. I thought
a lot of these guys had their inventory under control. That was the narrative that I got.
Macy's was a straggler.
Yet this inventory issue still continues. I thought actually Macy's was one of the better at managing it. But it turns out that this is an ongoing issue. It does seem to be a kind of a rolling crisis within the industry, what is happening with inventory.
Yeah.
But I thought the narrative more broadly was that inventory was under control, and as a result of which, you were going to see better numbers coming forward from here.
I think it was a Bloomingdale's issue in the last quarter, right?
Mm-hmm. Yeah, and I think what's been called out this quarter is seasonal issues. Some of these markdowns were related to seasonal products. I mean, though, you look ahead, you look into Halloween, you look into, you know, the holiday season generally. I mean, is inventory as well managed as we anticipated because this was happening a year ago? Consumers slowed down since then. Mm-hmm. You know, where do we go from here? I think it just raises more questions.
There's a simple solution to this. Basically, you buy clothes that are A, seasonally agnostic, and B, you buy a pair of shorts. They last you for a few years.
And
that's kind of my strategy. The Birkenstocks, I've had the Birkenstocks for many, many years.
But you
I don't wear them that often, but they're there.
You can't wear shorts in the winter.
You'd be surprised.
I
do.
And normal humans aren't like you. You don't buy one pair of jeans and then Macy's is not catering to the guy that buys one pair of jeans for 4 years. That you are not the target customer.
This is probably true. Otherwise, I think they may have been out of business a while ago.
A little bit. Their promotions would have been much, much bigger. So, Simone, before we let you go, just hit on Lowe's for a second. Is Lowe's just as cautious as maybe Dick's and Macy's are about the consumer?
You know, Lowe's actually did a little bit better than anticipated, and then this message is caution going forward, partly because of the less excitement about the housing market generally. But I think what's really interesting in both Lowe's and Home Depot is that the contractor side held up pretty well and came in fact, stronger than the DIY. Now, Lowe's is more tilted towards DIY. That's helped it this year. But it suggests that people do want to do projects. Contractors are still building new homes. So to that conversation that you guys were having earlier, I think there is a fair bit of strength there, maybe strength that wasn't necessarily anticipated.
You got to renovate, you got to do up, you got to make things bigger. That's the market we're in right now. That certainly seems to be reflected in the numbers we're seeing. Don't buy clothes, buy tools.
Or go to Europe.
Or go to what I'm doing.
I can see Alex Steele. Definitely doing that.
We're doing an extension. We are doing an extension. I am now.
No, when we say we, you are not doing it.
Well, no. I mean, I have contractors who are going to build an extension.
Okay.
But, you know, I'm part of the whole thing. Craig has floor plans.
Part of the process. Making executive decisions at a very elevated level, I would imagine.
Yeah.
Simone, very nice. Thank you very much indeed. So what are we going to talk about next? What is going on Wall Street? What's going on at Charles Schwab, actually, more specifically? More on the cost-cutting moves we're seeing at the bank in today's Wall Street beat. Sonali's next. This is Bloomberg.
Time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today, we're not talking about Birkenstocks. We're going to talk about the major cost-cutting over at Charles Schwab. Thank goodness for that guy. Bloomberg's Sonali Basak joins us there. Okay, so I feel like for Charles Schwab, haven't we been waiting for this to happen for a bit, ever since we had rates really move higher? Like, what's happening?
And there's another aspect here where they're integrating TD Ameritrade as well. So once the deal happens, of course, there are synergies that are put in between. But remember, we did see Schwab go through a series of pain through the regional banking crisis. In the most recent quarter, they had eased a lot of that pain, and they had beat expectations on very key elements, including deposits. And Wall Street was getting excited that the story for Schwab is getting cleaner. At the same time, they did say expenses would grow this year, and this is them getting a bigger handle on it. This is them saying that in addition to headcount reductions, they're going to shrink their real estate footprint. This will amount to about $500 million in annual cost savings. And on the heels of it, they went to the bond market to try to raise more funds as well.
Where are they shrinking the footprint, Sonali?
Well, it's non-client-facing roles, according to a spokesperson. Something I think about, guys, when you think about firms like Schwab, these were kind of the OGs when you think about the retail trading world and the ability to use technology to really ramp up their distribution across retail networks. And so when you think about headcount reductions here, I see it actually as an incremental squeeze on a market that has been shrinking headcount for years.
Mm-hmm. So this has less to do with rising rates and more of a structural issue?
A little bit of both. Remember, we did see them significantly pressured by rising rates. I definitely did ask to add to Schwab's problems.
That stock got hit so hard when that was happening.
Yeah, absolutely. And you saw some relief after the most recent earnings, after things started to stabilize a little bit. I think that that's an important element here. Remember, ratings firms, investors do have a close eye on this stock because, of course, they could face more pressure from rising interest rates. Not saying that's not a problem. Absolutely it is. But when you layer on some of the other idiosyncratic things about Schwab, like TD Ameritrade, then that picture becomes even more complicated, and it's as much about strategy as it is about that macro environment and those rising interest rates that they are definitely feeling the pain of.
Sonali, let's pivot to tomorrow and talk about this open meeting that the SEC is having. It's about private equity, it's about hedge funds, it's about the rules, it's about fees. how nervous is the hedge fund community about what is happening here and what Gary Gensler is up to?
Oh, they're absolutely not only nervous, they are ready to take legal action, Guy, if things don't go their way. So we have had proposals, hundreds of pages of proposals, and I was talking to Bloomberg's Lydia Bayoud, who will be there tomorrow, really attending and watching the vote happen in real time. Remember, the way the commissioners work on the SEC, even the SEC itself might have some disagreement within it. There are 3 Democratic commissioners that are expected to vote for the new rules, and we will see how it goes, but the Republican ones may have more pushback. The MFA, the Managed Funds Association, has told its members, according to an email obtained by Bloomberg earlier this month, that they would be prepared to sue within a couple weeks of the new rules coming out should they not be watered down appropriately. So certainly not only are these pretty significant rules for a $17 trillion industry, they are also going to face a lot of contest, potentially, in the next couple of weeks.
What are the possible rules here?
The reason the hedge fund and the hedge fund and private equity industry are so frustrated is it would require more disclosure around a broader set of fees here. So that is not just that 2 in 20 that you're used to, or that 1 in 10 that has been more typical. This is also monitoring fees and other fees that are charged, ancillary fees charged by private equity firms. Remember, there's also potentially a limitation of sidecar vehicles. These vehicles are special vehicles set on the side for special larger investors that tend to have preferential treatment. And the SEC is really trying to clamp down on that preferential treatment, which also can have special redemption rights associated with those investments. So you might actually see some pushback from investors, too, that enjoy that preferential treatment. Lastly, funds could potentially be sued more easily. And part of that is because instead of being sued for gross negligence, that standard can be brought down to more simply negligence. And that idea that they could be more open to litigation, there's a question and a dispute from the fund industry on whether that can discourage risk-taking, because it makes it more easy for their investors to turn against them if things go south.
Sonali, I can see why they're nervous. I suspect we're going to talk more about this tomorrow. Sonali Basak, Wall Street Beat. Hedge funds are definitely going to be paying attention to that tomorrow. That open meeting will be the subject of great discussion, I suspect. Okay, we're about to close the markets here in Europe. We're into the final run. Stock 600 being bid today by Basic Resources. That's the China narrative. Technology is having an okay day as well. Ubisoft is one of the main reasons why technology is up today. It is going to be the beneficiary of this Microsoft Activision deal that's being done with the UK. Yield to bid. Look at that. We've got lower yields today. Amazing to see that happening. Anyway, close is coming up next. This is Bloomberg.